Good morning, or good evening, depending on what time you are listening to this presentation. I have the same presentation, not narrated, also posted on Blackboard. You'll find it under the Week 7 assignment link. You'll also find it under the PowerPoint Slides tab on the opening page of Blackboard. And I'm also going to add, well, if you're listening to this, you know that I've also added the narrated portion, okay? I'm not going to cover all the slides that are in the narrated portion, but I just wanted to review some of the information you'll need for the exercise 6, which I've labeled here exercise 5 and exercise 6, which you will see labeled here assignment 5 and assignment 6. Okay, so exercise number 5 was the break-even analysis. This first chart here simply reviews the information that was provided in your readings as well as on the exercise 5 PDF file, okay, and it defines what break-even analysis is and hopefully just provides you with a review. And simply break-even is that point at which you're neither losing money or making money, okay, you're simply covering your fixed cost. So this gives you information on the calculations of break-even, and again, that's just a review of the information that was provided in the readings. This next slide, the break-even data, what I've done here is I have a description of the particular measure, for example, unit volume, unit selling price, promotional allowance, etc. And here in this second column, where you will find that information. So that's what I mean by sources of data. And I'm talking about the reports that are available in MarketShare. And remember last week we reviewed all of those 18 reports. You'll be using a subset of those reports to do the break-even analysis and the gross margin analysis. So here, for example, one of the measures that you'll need to calculate break-even is unit volume. You will find that in the sales report. Unit selling price, you can find that, or calculate that, I'm sorry, from the data in the income statement and sales report. The promotional allowance, you'll find that information on the income statement. Cost of goods sold, COGS, you will find that information on the income statement. Unit variable cost, you will find that information or can calculate that from data on the income statement and sales report. Total marketing expenses, your promotion, advertising, sales force, and administrative expenses, sorry, missing the end parenthesis there. You'll find that from the income statement. And finally, fixed cost, you will find that information or data on the income statement, okay? Now let's take a look at some of the calculations, and I've also included screenshots of some of those reports. So exercise 5, the break-even data, this is just the information I reviewed with you a minute ago. The description of the measures that you'll use to calculate break-even and where you'll find that information, okay? Again, I've reproduced, and this is simply the same information that was provided on the assignment PDF, the exercise 5 PDF for break-even analysis. This gives you some of the calculations and definitions of VC, variable cost, SP, selling price, PA, promotional allowance, and calculations of SP and VC, okay? But again, that is the same information. I've simply reproduced what was on the exercise 5 PDF. I have also given you screenshots of the reports from MarketShare that contain the information that you can either use directly to calculate break-even or that you will use in calculating variables for break-even, okay? So for example, if you want to know the unit sales or unit sales volume, you can pull that from the sales report, which is the report shown here. If you want to know the unit selling price, you will combine information from both the sales report, which will give you total unit sales, and your income statement, which will give you manufacturer sales in dollars. Okay, so this is sales in dollars from the income statement. The sales report will give you sales in units. Okay, and here we have shown you how to calculate the selling price. Okay, so if selling price is manufacturer sales divided by units, you'll use two of the reports. Here you pull manufacturer sales from your income statement. That's this value here. And the units you're pulling from your sales report. Okay, so unit selling price is an item or measure that you'll have to calculate. Okay, so hopefully, so what I'd like you to do is work through this. Again, this is the information from exercise 6. Again, the calculations from exercise 6, and I've just provided you with screenshots of the reports that they reference in those exercises, telling you where you might find the data. Okay. Now, exercise number 6 was the gross margin analysis. This first page here, again, reproduced from the PDF file for exercise number 6. And this just defines some of the terms that you will need to understand in order to calculate the gross margin. So we have MSRP, the manufacturer's suggested retail price, definitions here, volume discount, manufacturer selling price, MSP, promotional allowance, and price to channel. Now remember, when we're talking about manufacturer here and manufacturer here, that's your company All-Star, okay? Because All-Star and its competitors are the manufacturers in the market share simulation, okay? So here we're talking about All-Star, the company, when we're talking about manufacturer's suggested retail price. And manufacturer selling prices, again, for All-Star. When we talk about price to channel, that's the price that you're selling your product all around to your retail channel partners. So that's the drugstores, the grocery stores, and the mass merchandisers, okay? And your price to the channel, what you sell your product to the channel, the price that you sell the product to the channel for, oh, that was grammatically incorrect. That price represents the cost to the drugstore, the grocery store, and the mass merchandiser, okay? Because what they pay you is a cost for them. This price to channel is what you're making from the sale of your product, and is what the drugstore, the grocery store, and the mass merchandiser are paying you to obtain the product. This is not their selling price, right? They're going to have some kind of markup before they sell to the end user or the consumer, okay? Now, exercise number 6, the gross margin calculation, they have broken that up into 2 stages. So stage 1 is calculating price and margin data, okay? And you'll see that again at the top of the form, the PDF file for exercise 6. And this again is reproduced from that form. So we have price discount calculations for all around. The MSRP, your manufacturer's suggested retail price, that's information that you will find in your average retail price by channel report. The volume discount, also from that report. The manufacturer's suggested price, manufacturer's selling price, MSP is manufacturer's selling price. This is a calculation. So you'll plug your MSRP figure here, your volume discount percentage, multiply this number here times whatever your volume discount is to arrive at this dollar or cent discount here, okay? So you're going to take your MSRP and subtract from that the dollar amount of the volume discount to arrive at your manufacturer's selling price. So that's initially when you give your retail channel partners, the drugstore, the grocery store, or the mass merchandisers a volume discount, that's now the price that you're actually selling the product to them for. But wait, we're not done, right? Because we also talked about promotional allowances, which were some of those incentives that we give retailers to do stuff in store. And you might remember some of your colleagues sharing some of their experiences understanding the in-store promotional activities. Well, we're also giving our drugstore partners, our grocery store partners, and our mass merchandise partners cents off or some discount off the price so that they will engage in or do some of those in-store retail promotional activities for us, right? That's what this promotional allowance is. And again, you will find that percentage from your retail price report. Multiply this MSP times that percentage to arrive at the number here, okay? So you want to know what's your promotional allowance? It's some percentage of this number here, right? So this number you will plug in, subtract from that volume discount to arrive at your MSP, the manufacturer's selling price. Then we're going to look at the additional discounts that we give to the retail channel partners, which is the promotional allowance. We're going to subtract the promotional allowance from the MSP to arrive at price to channel. Now, price to channel is the price that you sell your all-round product to the drugstore, grocery store, mass merchandisers. For them, that is a cost. While for you, it is a price to which you're selling them the product. For them, it's a cost of doing business with you, okay? And again, I have a screenshot of the report from MarketShare from which you can pull this data, okay? And if you advance beyond period 0, you can pull current information. But again, I just wanted you to have a screenshot of the reports that have the information you'll be looking for. Now this next slide is still from exercise 6 in the calculation of gross margin, but this is stage 2, channel pricing analysis. So the first step in this, and this is from the exercise 6 PDF file, you'll notice that that was one where we have this box at the top, and there are 3 boxes at the bottom for drugstore, grocery store, and mass merchandiser. I've separated those into 2 different charts. So first we're going to focus on All-Star brands and doing the calculation of margin just for All-Star overall, okay? The MSRP, the MSP, and the price to channel go back to the previous chart and previous slide, the previous table, right? Stage 1. You've already completed these calculations, so you need to plug your manufacturer suggested retail price on this line, your manufacturer selling price from your previous calculation here, your price to channel here, okay? Now your per unit cost, you can do one of 2 things. You can either calculate your per unit cost from your cost of goods sold, which is on your income statement, and from total unit sales from your sales report, or you can find the unit cost or an estimated unit cost on the product decision report. I've included a screenshot of that product decision report just so you'll see where that information is, okay? So once you find your cost information, you'll put that information here on this line. Then what we're going to do is we're going to subtract the per unit cost from the price to channel. As remember again, this is your revenue for the product, or how much money you're making. Excuse me, let me just say this is how much money you make when you sell the product to your drugstore, retail store, drugstore, grocery store, and mass merchandise retail channel partners, okay? This is your price here. You're subtracting from that the unit cost, and that will give you a dollar margin, okay? So here, dollar margin, price to channel minus per unit cost. Now I've changed this calculation here of the percentage margin. Oops, I didn't change it up here, so please forgive me. But on this table, on the PDF file, Interpretive said to calculate the percentage margin by taking the dollar margin, this number here, and dividing it by MSP. You can do that, but you know what? I'm suggesting that we go ahead and use the price to channel. And the reason for that is price to channel is your final price minus all of the discounts. So it doesn't matter. I mean, the number won't be significantly different, okay? And if you understand in theory what you're doing, and if you do whatever approach you use the same approach for all of your calculations so that you can do a comparison. So again, Interpretive on their forms, they're calculating percentage margin by using a dollar margin divided by MSP. I'm actually using price to channel, okay? Feel free, price to channel or MSP, you can use either one of those figures, okay? Now these next charts are those bottom 3 tables that fall underneath the calculation you just completed to determine your margin for All-Star as a company as a whole for the all-around product. Now, stage 2, the channel pricing analysis, what we also want to take a look at is we have our overall margin. I'm not giving you these numbers, of course you'll calculate those, okay? We had our overall margin for All-Star and the all-round brand, which is the only brand you currently offer. But one of the questions we want to answer is, does that margin differ in the drugstore, in the grocery store, and in the mass merchandiser? And probably the answer is, well, yes, maybe, or no. But this is why we're going to do these calculations here, okay? So this is still part of the stage 2 channel pricing analysis, but now we're looking at for drugstores, for grocery stores, and for mass merchandisers. So here you need the actual retail price for each of these channels, and you can pull that from one of the reports that is available in MarketShare. And I've included one of those reports from which you might pull that information. Your per unit cost to channel, that is calculated earlier. And go back to that and simply pull that information from that earlier table, okay? And to calculate the dollar margin for each of these channels, what you're going to do is take your actual retail price, subtract from that the per unit cost to that particular channel, and that will give you this number here, the dollar margin. You're going to notice that the per unit cost to channel for all round in each of these channels is the same. The retail price will vary, okay? And that's one of the things that we want to look at. We want to look at the margin here, because your calculation here is going to be actual retail price minus per unit cost to channel to give you a dollar margin. You'll do that for each drugstore, grocery store, mass merchandiser. Per unit cost to channel is going to be the same in our example, okay? The margin here is going to differ. And if you think about it, it will differ because the actual retail price is different in each of these channels, right? And then you'll calculate your percentage margin.